I want to take a moment before we go any further, just to set the context. If you're new here, I'm Paula. This channel isn't really about reacting to daily headlines or trying to predict what markets will do next. What I'm interested in is understanding how the world actually works, especially at moments when the usual explanations stop being enough. This video is part of a longer series where we're stepping back and looking at what's changed beneath the surface in money, markets, and power, and why so much of the world feels different right now, even when nothing dramatic appears to be breaking. In the first episode, we talked about how nothing ever really gets resolved anymore, how problems are managed rather than reset. In the second, we looked at what happens once a system starts managing limits instead of expanding freely, and why money quietly stops being neutral when that happens. This episode follows naturally from there, because once money becomes strategic, once access matters more than outcomes, the form money takes starts to matter far more than it used to. And that's what I want to explore today. For a long time, the form money took didn't really matter. Cash was cash. Bank deposits were bank deposits. Payments were slow, local, and mostly invisible. The plumbing existed, but no one really paid attention to it. As long as growth was strong and systems reset cleanly, the form of money stayed in the background. What matters was how much there was, not how it moved. But once systems become constrained, that changes. When access matters, when trust feels fragile, when money becomes a tool of prioritisation rather than neutral exchange, the plumbing stops being boring. It becomes central. You can see this shift most clearly in how much attention is now being paid to payments, settlement speed, clearing systems, cross-border transfers, who can transact and who can't. These used to be technical details. Now they're strategic questions, because when money flows easily, friction doesn't matter much. But when money flows conditionally, friction becomes power. Think about how rarely we used to talk about settlement. Most people didn't know how long international payments took, or which systems sat underneath them, or who ultimately controlled access. It didn't matter. Now it does. Because when access can be restricted, delayed, or revoked, the structure of money becomes important in a way it was never before. This is where digital money enters the picture, not as a trend, but as a response. Not because it's exciting, not because it's new, but because it changes how money moves. Digital money settles differently. It moves faster, it crosses borders more easily, and it doesn't rely on the same layers of trust. That doesn't make it better, but it does make it different. And difference matters in a constrained system. This is also why stablecoins have quietly become one of the most important developments in finance, even though they rarely get talked about properly. They don't promise disruption, they don't promise freedom, they don't promise price appreciation, they promise functionality. They move value efficiently, they settle quickly, they operate across borders without asking permission every step of the way. And in a world where access matters, that's significant. What's interesting is how institutions have responded to this. Early on, the instinct was rejection, then came caution. Now we're seeing something different: absorption, regulation instead of bans, framework instead of shutdowns, integration instead of exclusion. Not because the system suddenly loves innovation, but because outright exclusion creates risk in a world that can't afford instability. Managed inclusion feels safer. This is a pattern we've seen before. When new infrastructure threatens to sit outside the system doesn't always destroy it. Sometimes it pulls it closer, defines it, frames it, controls its edges. That's not ideological, it's structural. This is also why conversations about digital currencies often miss the point. They get framed as old money versus new money, freedom versus control, decentralization versus authority. But that framing assumes we're still in a world driven by growth and replacement. We're not. We're in a world driven by constraint and management. And in that world, systems don't replace things easily, they adapt them. This is where crypto often gets misunderstood. Crypto isn't forcing this shift, it's highlighting it. It shows what money looks like when settlement is fast and access is open and trust is minimised. That doesn't mean it replaces everything, but it does mean it becomes part of the conversation, whether institutions like it or not. What really matters here is not ideology, it's optionality. In a constrained system, optionality becomes valuable. Different rails, different settlement models, different ways for value to move. Not because one is perfect, but because no single system can handle every scenario anymore. This is why we're seeing parallel systems emerge instead of outright replacements. Traditional banking doesn't disappear, but it changes. Digital money doesn't take over everything, but it finds its place. The future isn't about one system winning. It's multiple systems coexisting, managed, regulated, and strategically important. And this is why the form of money suddenly matters. Because once access becomes power, the way money is structured determines who can move, how quickly, under what conditions, and with whose permission. Those aren't technical questions anymore, they're strategic ones. This doesn't mean that we're heading towards some dramatic financial revolution. It means we're watching the plumbing get upgraded in real time, carefully, slowly, and unevenly, which is exactly how systems behave when they can't afford to break. Once you see this, a lot of things make more sense. Why stablecoins are regulated instead of banned, why digital currencies are discussed in terms of resilience, not ideology, why payment systems are part of geopolitical conversations, and why crypto keeps showing up, not as a headline, but as infrastructure. This series isn't about telling you which system wins. It's about helping you understand why the conversation shifted in the first place. Because once you understand that, the noise becomes easier to filter and the future becomes less mysterious. In the next episode, we're going to look at something that keeps surfacing whenever markets feel tense: liquidity. Why it matters so much, why it moves markets before headlines, and why places like Japan keep appearing in conversations that seem, on the surface, unrelated. And that's where we'll go next. Before I wrap this up, just a quick word. If this way of thinking resonates with you, make sure you're subscribed. This series is designed to build layer by layer, and each episode adds context that makes the next one clearer. And if you found this useful, a like genuinely helps more people find content like this. Content built for understanding, not reaction. Now, understanding the world is one thing, knowing how to operate inside it is another. That's why we've made a completely free course called the Crypto Liftoff course, where we break down the exact framework and strategies we use to trade in both the bull market and the bear markets, without chasing headlines or emotions. The link is in the description below. And finally, if you ever feel like you're trying to make sense of all this on your own, that's exactly why we built the Crypto Wolfpack. It's a community where people talk through markets, macros, and charts together without noise, hype, or isolation. Thank you so much for watching this video. I'll see you in the next one, which will be posted tomorrow.